we all have to take a step back. First of all, the technical damage that was done in December with not only individual names, but a lot of different sectors and indexes is legitimate. And so I think you're going to continue to see the market kind of, the S&P kind of hit that 2,600, 2,640 range until we break out. But I do think ultimately we really can't get a break, because once one headline goes away, like the Fed, we all feel comfortable with Powell and kind of his narrative and commentary, and then the shutdown, which I think obviously will end at some point. But every day that goes on, that's another headline, because you saw, Southwest Airlines wants to go into Hawaii, but they need the FAA to approve. You've got Marriott's having trouble. And so I think the headlines are going to continue to keep this market in a range bound. But definitely, I think to Mario's point, we have to have, a China-U.S. Settlement, because those two countries are over 50% of global GDP.
So Mario, what about the Fed? Are you comfortable with where the Fed is now? Do you believe that they're going to get it right?
All right. The last 10 years, we added $10 trillion. We're pulling it back with Draghi, Kuroda, and Jay Powell now. And so that withdrawal or no increment is certainly an element. So is Dalio right with regards to the debt? Yes. And how do we handle that? So is Jay Powell doing a practical job? Yeah. Now,
should they have raised rates in December?
Should they? I have no idea.
Was that a mistake?
Whatever. I don't think so. My own reaction is you got to get normal. Listen, I'm running a $2 billion fund that's even lower cost than Vanguard's. But it's 100% U.S. Treasury. Money's pouring in at 2.4% and no SALT tax, because it's 100% Treasuries. Yes, someone is saying we have to be practical. The good news, the great news, the best news is that the multiples of companies I was worried about 5 years from now, could I get the same multiple on earnings looking out 5 years as I can today? They were too elevated. They're now down to very interesting levels for a lot of the companies we follow in the small cap world.
So did you take advantage of the
we're
unrest to add to positions?
No, we're 100% mandate to be 100% invested, practically speaking, for clients all the time. We're an equity manager. We're strictly an expert on your left knee and so on, so that we are not holistic. We're not wealth managers. We might migrate into that in the future, but at the moment, we're equity managers, and that's what we look for. So I'm preaching for my church.
I understand, but when the market really turned down in December, were you looking to raise some cash at all? Well, or were you deploying some cash because you saw multiples were more attractive?
In the month of January, you had the absence of the tax selling and the window dressing. They sell the losers. They want to hold their winners. You had the reverse of that in January. We're working our way through that. We've had stocks that went from $3.50 to $6. Is that good? The stock was down from 10. That doesn't make me feel better. I just look at the intrinsic value of the enterprise and look at what happens on a going forward basis. Will the multiples 5 years out be the same as I'm buying today? And if I'm buying them at 6, 7 times EBITDA, that is a very, gives me a margin of safety that I haven't had in a long time.